Alright guys, welcome to another lecture. We're going to talk about a whole bunch of new stuff over here today with you guys. We're going to talk about chapter 5. I'm going to introduce you the dynamics of chapter 5, but before that I hope you're having a great day and I hope you're staying on top of everything. Please don't forget to check course schedule, assignment, and upcoming deadlines. And as always, if you have any questions, please let me know, and I will be happy to answer your questions before you submit any class material or class assignment. So guys, we're going to talk about financial statements today, right here, okay? Let me tell you this before I go into details. In today's class, we are not going to calculate anything because this chapter is a review chapter, and this chapter is a review chapter. All we are going to do, as you can see in the lecture outlines right here, we are going to understand the financial statements. We will talk about the major financial statements we have. As you know, let me introduce you here in the lecture outline. We have the balance sheet, income statement, which is the profit and loss statement, or in short, P&L statement, and then we have the cash flow statement. As you can see right here, what we're going to do, we're going to talk about the, we're going to define those statements, we're going to talk about the purpose of those financial statements, we're going to see the details of the financial statements, and there are different components for each one of them, and then we will talk about them in detail in this video lecture today, okay? First of all, let's talk about the financial statements itself. Guys, financial statements represents the financial condition of the companies, of the hospitality companies. Revenue expense balance, asset liability balance, equity balance. We have, let's say, two major items in the equity section: capital and the retained earnings. How much capital we have from the other people, this is from the investors' money, or the money we raised in capital markets. Retained earnings, this is the transferred earnings from the income statement as net income or net loss. So we will see all of these. Again, there are three major financial statements, even though there are tiny little bit of financial statements that's out there in the business world for the hospitality companies. For example, departmental revenues, or any other statements for tax issues, for specific the cost issues, or any other little tiny itty-bitty financial statements. We have all these. However, we're going to focus on the balance sheet, income statement, and the cash flow statement today, and then we will recap our knowledge about those statements, because for chapter 6 we will need them, since we are going to perform ratio analysis by touching base with every single edge and corner of the hospitality company's operations. Clear picture of financial condition of the companies. Financial statements show them, okay? They demonstrate a clear picture. They demonstrate the cash inflows and cash outflows, and of course the bills, expenses on the financial statements. And then we all need them for decision-making process, especially for the internal decision-making process. We have, in the financial statements there are plenty of information, okay? Firms' policies, firms' liabilities, loan structure, firms' asset balances for the current assets, which are liquid assets, fixed assets, buildings, land, properties, equipment, fixed furniture, you name it. We see them as well. Therefore, since we have a lot of information presented in the financial statements, for three of them combined, income statement, balance sheet, and the cash flow statement, there are multiple users of those statements, including financial analysts, lenders, even employees, government, IRS, for example, or Securities and Exchange Commission, for example, okay, competitors, and any other investors, okay. It could be an institutional investor, it could be an individual investor, okay. Therefore, we have a lot of users of the financial statements, okay. Different users would like to read different stuff, guys. They would like to read different components of the financial statement. For example, Imagine a lender or a creditor, which is, it could be any investment firm or lending company or a bank, simply a bank, okay? If any hospitality company would like to withdraw or take out additional loan, or any loan, it could be 10 years, it could be 15, it could be short-term loans, okay? Short versus long-term loans. Creditors are interested in looking at the debt situation of the companies, okay? Liability section of the balance sheet, we are going to go over that again right now in detail in 5-10 minutes. But they are interested in analyzing the liability condition to determine the terms and conditions of the loan, the interest rate, the length of repayment of the loan, and any other stuff associated with the underwriting the loan. They would like to see their liability situation, how much debt the companies they have, are they going to be able to pay the interest payments at the time, which is, at the due date, and so on and so forth, okay? So, and other users, for example, they could be, hey, I need information about the company, for example, how much, let me just scroll down, okay. How much return I can generate? Are the earnings sufficient for me to generate enough returns? What about the cash flows? Are there enough cash flows coming in from the investment activities? We can talk about cash flows. Are they, for example, they provide good opportunity for employment, for the retirement, for the annual salary increases or the bonuses, employee packages, employee stock options, employee retirement option, all that. They need the individuals ask themselves, and they find answers by looking at the financial statements. And of course, degree of risk is a lot to do with the liability section of the balance sheet. Therefore, in creditors, investors, they are curious to find out companies' financial condition. Even customers take a look at too. If I buy if I buy a product from the company, are they going to be post-purchasing activities? Are they going to be enough support for the post-purchase? Am I going to find somebody to talk about the product if something goes wrong? Those kind of stuff are very important, and then all those information are placed in the financial statements. So guys, we're gonna start with the balance sheet. Okay, balance sheet is one of the most important financial statements, and the balance sheet, of course, shows the financial condition of the company. It shows the financial condition of the company at the time it is prepared. Okay. I will talk about this at the time it is prepared. For example, on October 10, 2017, 2018, 19, okay, or September 13th of 2018. So at the time it is prepared, it shows the financial condition in terms of the assets, liabilities, and stockholders' equity, which is the owner's equity. It's the alternative name of that last section that we have. Okay. We have asset section in the balance sheet, liability section in the balance sheet, and the owner section in owner's equity section in the balance sheet. And assets, liabilities, and owner's equity section has to follow the fundamental accounting equation. We know this. I'm going to show it to you right now. But fundamental accounting equation, A is equal to L plus E, and we know what they are, right? These are the assets. Total assets, of course. These are the assets. We have liabilities over here, and we have the owner's equity over here. So the total value of the assets has to be equal to total value of liabilities plus the total value of equity, and of course the balance sheet follows this fundamental equation. Okay, we are going to talk about this more. We are going to decompose the balance sheet by analyzing all the components, and then hopefully you will get to visualize it better when you are studying for the for the test, or when you are studying for the lecture, which is chapter 5. Okay, so guys, there is a limitation for the financial statement. Why? As I said, on the day it is prepared, balance sheet only shows asset, liabilities, and equity balance, which is the financial condition in terms of those items, okay, on the day it is prepared. As I said before, it could be February 10th, it could be January 24th, 2018, and it shows that. So therefore, it is not cumulative like the income statement. So balance sheet, we know that is not cumulative because it is only prepared on the day, or it only shows the financial condition of the company in terms of the assets, liabilities, and the equity on the day it is prepared. Therefore, it is not cumulative, just like the income statement. So we're going to touch base with it again. Please don't forget, this is an important information for the test. You know why I said that. So please don't forget this information right here. And this is the most important distinction between the balance sheet and the income statement, guys. Okay? Let me clear this real quick, and we're going to jump to the components of the balance sheet. We have three main components of the balance sheet, guys, okay? Let me just scroll up. On the left-hand side of the balance sheet, I'm just going to put BS over here, but it's balance sheet, okay? So on the left-hand side, we have the assets section, okay? Under the assets section, we have CA, current assets, and we have FA, fixed assets. So CA plus FA will be equal to total assets as TA, okay? So guys, current assets are listed in the order of the liquidity position of the asset items. For example, current assets, let me just draw an arrow over here. We have cash, we have MS, marketable securities, we have receivables such as accounts receivable, we have inventory, and we have prepaid expenses or prepaid items, okay? So this has to be in order. Cash cannot be on the second place, or receivables cannot be on the first place, because the order of all the current assets are based on the liquid condition of those items. Starts with the cash, and we have to put prepaid expenses, for example, insurance or any other prepaid expenses at the very bottom, guys, okay? So this is the left-hand side of the equation, and this is the characteristics of the current assets. We have one more asset section, and then, as you know now, they are the fixed assets. Please focus on here, fixed assets. Guys, fixed assets are the assets, okay? Most of them cannot be carried, physically carried, and their useful life is more than 1 year, okay? Such as, look, equipment, land, building, machinery. Let me just do this. Machinery, property, any fixed, such as desk, chair, spa equipments, or let's say imagine a hotel, and then in the kitchen equipments in the main kitchen. These are the fixed assets. You cannot carry them over physically somewhere else, okay? They are mostly tangible, and their useful life is more than 1 year. Some of the assets produce cash flow, some of them don't produce cash flow. We will also touch base with them. For example, building itself don't produce cash flow, and it has depreciation. However, all the other assets, for example, pool might produce, and it produces cash flow, such as being a membership for the recreational areas or the wellness center of the hospitality companies or the properties. Therefore, some of them produce the cash flows. Before I jump to the right-hand side, right here, guys. So this is the left-hand side of the balance sheet. On the right-hand side, we will decompose the liability section. But again, let me remind you this: current assets plus the fixed assets, they are equal to total assets. Okay, guys? Very good. Okay. So we have the liabilities section on the left-hand side. Under the liabilities section, we have CL, current liabilities, and we have LT or LL or LL or LL. We have the long-term liabilities over here, and when I add those up, guys, okay, I will have the TL, which is the total liabilities. Okay, long-term liabilities, their repayment obligations right here. The repayment obligations are under 1 year. For example, payables, accounts payable, notes payable. Short-term liabilities, they are usually short-term loans. Accrued expenses, advanced deposits payable, and deferred income taxes. These are listed under current liabilities, which means their repayment structure is less than a year, usually up to a year. Okay, On the other hand, additionally, sorry, we have the long-term liabilities over here. Long-term liabilities, LL or LT. Their debt obligations, repayment structure are more than a year, okay? For example, take a look at this, guys. Let me just, I will keep cleaning, by the way, so you can see, you can see the lecture better and follow the lecture better, because I would love to point it out, so it will be easier for you. These are right here. They are the long-term loans, notes payable, of course, in the long term. Mortgage payable for the buildings. Okay, we are talking about the commercial mortgage payments, of course. Bonds payable. If the company issues any bond, you will learn this in your financial management course. They do have the payables in terms of the coupon payments. I'm not touching base with the details. And any other long-term payables which are in the form of long-term loans, and they are listed under the long-term liabilities section of this. So what we have right now, we have current liabilities, long-term liabilities. When we add those up, I have the total liabilities, and this is the one of the most important sections of the left hand. We have one more, okay? We have one more. It is called owner's equity. Okay, owner's equity. Owner's equity is difference between total assets and the total liabilities. And in the owner's equity, we have two major items: capital and retained earnings, common stocks, people's money, other people's money, investors' money, that the money we raise, the funds we raise in capital markets, in financial markets, and retained earnings, generally generated as earnings, but not distributed for investments or dividend reasons, and it is coming from the income statement. It is transferred from the income statement. We have all these. Therefore, as you can see, assets are equal to liabilities plus the equity. Capital we have, and we have our retained earnings. Therefore, we maintained A plus L. A is equal to L plus E equation for the balance sheet. Okay, guys? Let's visualize the components over here. Of course, one more thing I would like to mention: owner's equity increases if revenues exceed expenses in the income statement, and if the revenue is less than the expenses, owner's equity will decrease due to the retained earnings. So please don't forget that. It's a great information, important information to remember for your course and class assignments. Okay. Take a look at the balance sheet over here. This is the visualization of the balance sheet. Let me just scroll down. You can see it better. What we have right now, we have assets over here. Current assets, fixed assets. The total of CA and FA is equal to total assets. That will be equal to liabilities. These are total liabilities. We have current liabilities plus long-term liabilities. Current liabilities plus long-term liabilities, of course, total liabilities, and equity. There are two important items as the capital and the retained earnings. So this is a great representation of the balance sheet. So this, and every single company, including the hospitality companies, they have to follow this order, which is obligated, which is enforced by GAAP, and the equation. This is the equation right here, guys. Okay, let me just clean this real quick. So take a look at this while I'm cleaning it. This is how the balance sheet looks like. This is just the example company. Okay, I will go over the components one more time quickly. Okay, but let me just erase this first, and then I will go over that quickly. Okay, so we have the assets over here. As you can see, current assets, cash, petty cash, temporary investments, accounts receivable, inventory, supplies, prepaid insurance. As I told you, that liquidity position is important over here. And starting from here, these are the fixed component of the total assets. And then we have other assets, then we have total assets. And then when we go up, let's take a look at the left side of the balance sheet. We have liabilities, first current liabilities, then the long-term liabilities, and then we are going to jump to the stockholders' equity, owner's equity, they are the same thing. Then $707,000 has to be equal to total of left side as well. So this is a great representation of the balance sheet, and we are going to use them in chapter 6 while we're going to, when we start performing the ratio analysis. Okay, guys? The other important financial statement we have is called income statement. Income statement, it represents economic and operational performance of the companies, and thus the financial condition in terms of revenues and expenses. It can be prepared annually, quarterly, monthly, or sometimes weekly. It can be prepared based on different departments as well. It is cumulative, okay, from January 1st in a given fiscal year until December 31st. Whatever you have in terms of revenues and expenses, then the gross profit, then tax and net income, net loss, cost of goods sold, unit, and all the expense items, it adds up. Okay, therefore net income, net loss at the very bottom, it changes all the time. Revenues represents the inflow of assets, reduction of liabilities, and the cash and the credit payments like accounts receivable or the prepaid payments or expenses, unprepaid stuff. Okay. And expenses are defined as the outflow of the assets. Net income is defined as the increase in assets, decrease in liabilities. Therefore, the combination sets the net income or loss. Clearly, if the revenues are greater than the expenses, companies realize net income. If not, companies realize net loss. That means there's a decrease in assets, increase in liabilities. Therefore, net loss will have the negative value in calculations. Okay. Cost of goods sold right here is another important component of the income statement. Represents the cost dollar amount or as the cost percentage from the sales activities. Whenever we sell, there is a cost portion to it, so it is listed under the revenues. Therefore, cost of goods sold becomes important. Therefore, when we have the sales, okay, earnings from the sales minus COGS, cost of goods sold, it sets the gross profit, as you can see over here, guys. Okay, I'm going to show you the sequential layout of the income statement, but I'm just going over the components with you right now, and I'm going to compile what we're talking right now and show you the layout, and it's a great layout. Okay. Fixed charges, any fixed expense that reoccurs on a regular basis. There are some fixed charges like lease expenses in the income statement as well, and there are some extraordinary items unrelated to the ordinary or typical activities, business activities or operations. But if any hospitality company has an extraordinary item, it is also listed as the in the income statement. Therefore, take a look at this over here, guys. Okay, we're going to start with the revenues coming from the sales. Then we have the cost of goods sold equals the gross profit right here. Then we have the overhead expenses. Then financing costs and tax issues over here. Then we have the net income or loss. Either we have net income or net loss depending on the operational activities, business activities of the hospitality companies. So this is the great layout of the income statement, and take a look at this example right here, guys. We have sales, cost of goods sold, and the gross profit, $25,000. We have operating and overhead expenses. Take a look. These are the operating expenses, the list of operating expenses. Okay, there are some debits and credits, as you can tell, and the operating income becomes $12,000 because $25,000 minus $13,000 is equal to 12 grand. We also have interest revenues, okay, other interest expenses or gain or sale of an investment. Okay, these are related to investment, cash flows coming in or going out from the investment activities. Okay, loss from a loss hit, extraordinary item. Okay, and we have the total non-operating expenses, therefore non-operating revenues, therefore $12,000 plus $6,000 will be $18,000. This company, this hospitality company realizes a net income over here, guys. Okay, so this is a great representation of an income statement as well. And lastly, we have the statement of cash flows. Statement of cash flows is important because it provides aggregate information about all the cash inflows, okay guys, from the ongoing operations and external investments and from the financing activities. So we have all cash inflows, all cash flows are listed, okay, and those activities, those cash flows and inflows comes from three different segments from the business operations, and then there are three distinctive parts of the cash flow statement. We have operating activities, financing activities, investing activities, okay? So when analyzing company's cash flow statement, each of the activities become very important, okay? Because it shows the sources and the uses of the cash, how the companies use the cash, and how they calculate it, and then they come up with the cash on hand coming from the prior year until the current year. They show everything. So in the operating activities section, we have cash transactions related to revenues coming from the sales, of course, cash inflows and expenses, cash outflows, okay? It converts the items reported on the income statement from the accrual basis of accounting to cash. So the operating activities section does that, lists revenues and expenses, and it shows the operating activities in terms of the cash flows. So let me highlight one thing over here, guys, which is very important. If the cash from the operating activities is consistently greater than the net income, the company's net income earnings are to be set high quality. Otherwise, vice versa, it will raise a red flag. That's why red flag terminology comes from that. If the cash flow from operating activities is less than the net income, that means you are not, as a company, you're not creating enough cash flow, therefore you're realizing net loss, therefore there's a red flag in there, okay? So this is the operating activities, again, based on revenues and expenses. In the financing activities section, we have cool stuff here that I like, actually. We have the issuance, retirement of debt, and issues of repurchase of capital, common stock balances, activities. So there are activities from the external side of it tied to cash flows. Cash inflows include cash receipts from the issuance of common stock. People are buying it, investors are buying it, short-term, board-term borrowing, and the short-term and long-term borrowing. Cash outflows, repayment of the loans, interest in the form of interest expenses, or any coupon payments on the debt issuances, or the dividend payments to the investors when they buy common stock. Again, this terminology might not, you guys are not might not be familiar, but in financial management course, when you bridge the gap between managerial accounting and financial management, this terminology adds up and it aligns and it makes much more sense, okay? Last section is the investing activities over here, guys. Investing activities, we're talking about the cash flow, let me just erase this. Investing activities tied to cash flows from the acquisition or disposal of non-current assets, especially property, equipment, and investments, okay? Either disposable or acquirement of all those assets, okay? Purchase and disposal of marketable securities as well. Companies can be investors as well. Hospitality companies can invest their extra capital into short-term or board-term investments, and then they can acquire more or dispose more when they feel like it, when they feel that's right time to do it. So investing activities lists all those in the statement, okay? There are two different methods to calculate the cash flow statements, because we are going to calculate cash on hand for the current year, direct method, indirect method. It does produce different numbers, okay? So for example, direct method shows the cash receipts from the sales and cash disbursements from the expenses, but indirect methods used in determining net cash flows from the operations, and it starts with net income. Clearly there are differences. I'm not going to touch base with it. I'm not going to focus on that too much. But yeah, so it doesn't matter. It's up to the companies to utilize either direct method of cash flow calculation or an indirect method of cash flow calculation. Guys, our cash flow statement starts from cash flows from operating activities, and then cash flows from investing activities, then the cash flows financing activities. These are three distinctive segments of the elements or the sections of the cash flow statement. And then we will have net increase or decrease in cash. Cash at the beginning of the period, this comes from the prior period. At the end of prior period becomes at the beginning of this year. Therefore, cash at the beginning of the period, and all we have to do, the ultimate objective of the cash flows statement is to calculate the cash at the end of the period. Therefore, it is the cash on hand. Okay, take a look at this. I'm going to show you an example, and this will be the end of our short lecture today. So this is Good Deal Corporation. Of course, these are all examples. We have operating activities, net income listed as the plus sign, increase in inventory, increase in supplies. This has to be negative because we have to convert plus and minuses. Again, I'm not touching base with them, not for this course. We have investing activities, purchase of an office equipment, of course it has to be listed as negative, and proceeds from the sale of an office equipment, it has to be listed as negative, positive because it's coming in. Okay, if proceeds from the sale, it's coming in, the cash flow coming in. And then we have the financing activities, and then lastly we have financing activities, investment by the owner, they are the shareholders, owners are the shareholders. So net increase in cash in this period is 1750. There was no cash from the prior period at the beginning of this year. Therefore, cash at July 31st, when it is prepared, we have $1,750. Therefore, it shows the cash position of the companies based on operating, financing, and investment activities of the company. Okay, guys? So this concludes our video, chapter 5, and it's a short video, I told you guys. In chapter 6 we are going to do ratio analysis, and then we're going to be utilizing the financial statements that we learned today, and then we will take it from there, and then we will do some cool stuff for internal performance analysis and thus decision making. Until the next video, I will see you guys until the next video. But as I told you guys before, please check the course schedule. If you have any questions, come talk to me, send me an email, make an appointment, and please make sure that you are aware of the upcoming deadlines, and have a great day, guys.